Hey everybody, I'm Jim Moore, founder and owner of ProfessionalExamTutoring.com. Today we are bringing you our SIE cheat sheet, the 7 most important SIE exam topics. Let's take a look at what we're going to cover in this lesson. First, we're going to take a look at the Slobs over bliss acronyms. That's going to be our stop orders, limit orders, etc. Then we're going to take a look at nominal, current, yield to maturity, yield to call, all the different yields. These topics can tend to confuse people a little bit, so we're going to dive right in there. And then in the money versus out of the money. This is crucial for the exam. You want to make sure you have this solid, because if you're going on to the Series 7, you're really going to want to have this down pat, because options only gets worse from here. Okay, then we're going to talk about corporates, munis, and treasury bond rules, forward splits and reverse splits. That's going to be stock splits. And then the difference between easy and restrictive monetary policy. This one tends to confuse people a little bit too. And then clarifying the margin rules. The margin rules aren't particularly confusing. However, most people overlook them, and they can be a point or two that are worth knowing because they're pretty simple once you get them. Okay, so that's it in terms of a summary. Now, one thing to warn you, we do go through these topics quite fast. If you need more detail, please check out our much more comprehensive videos and our video courses at ProfessionalExamTutoring.com, and you'll see a lot more detail. But for now, let's get started. Okay, the first topic we're going to look at is with regards to the Slobs over bliss acronym. Now, the Slobs over bliss acronym comes directly from the trading securities section, or some of you may recognize it more around the stop orders and limit orders. Now, when we're setting up an order, we want to know where we should put the price, or where the price is expected to be placed with regards to the market price. So we come up with this acronym, and in fact, we didn't come up with it, but many people use it. It's called Slobs over bliss. Now, when it comes to Slobs over bliss, Slobs is over the market price, and bliss is underneath it, which we'll get to in a second. And when we think of Slobs, it's sell limit or buy stop, and bliss would be buy limit and sell stop. So if you're setting an order which is a sell limit order or a buy stop order, that would be if you're expecting the price of the stock to go up and hit that order. And for bliss, you would set a buy limit order or a sell stop order if you're expecting the stock's price to go down and eventually hit where you're setting your order. Now, the other thing to keep in mind is that not only will the Slobs and bliss tell you the direction where the stock price should be heading, it will also tell you where you should be setting the orders. So the sell limit and buy stop should be set above the market price, whereas buy limit orders and sell stop orders should be set below the market price. So for example, if your market price is $50, your buy limit or sell stop should be set at $49, $48, $47, etc. And sell limit or buy stop would be set at $51, $52, etc. Okay, let's take a quick look at a couple practice questions on this. Which of the following orders would be placed above the market price? Now remember, it's Slobs over bliss, so above the market price would be the over part, so Slobs is over the market price. So Slobs would be sell limit or buy stop. So we see here we have buy stop is actually the very first one. That'd be our answer. Okay, and now we have if the share price declines, which of the following orders would not be placed? So a way to look at these negative type of questions is just flip it around. So which of the orders would be placed? So if the price is going down, we know that it's going down when it's bliss, because Slobs over bliss. So buy limit, sell stop, we know that those two are where they would be placed. It wouldn't be a market order because that's not even one of the orders that we're dealing with. We're just dealing with stop orders and limit orders. So therefore, it's got to be the sell limit order. Okay, so next, let's start talking about yields. So we have nominal yield, current yield, yield to maturity, and yield to call. These yields are often presented in a lot of the textbooks in some sort of seesaw type of diagram that most, if not all of my students find extremely unhelpful. So if you do find it helpful, stick with that. But if you need another way to look at it, in our video courses, we go through a really easy hand trick that we kind of came up with on the fly as we were teaching these courses online. And so that's on my video course. This is kind of an alternate to the hand trick, so it's through PowerPoint form, so you can see it here. But this might help you as well. Okay, so we're going to start off with an example. 5% ABC corporate bond. So if you have a 5% bond, and if it starts out trading at par, meaning the price is 100 or the value is $1,000, all four yields here will be equal to the coupon. So that's kind of a rule of thumb that you want to start out knowing, is that when the bond is at par, all these yields are equal to the coupon. So we know the coupon's 5%, all the yields are 5%. Nominal yield, which is coupon, but current yield, yield to maturity, yield to call, all of them line up at the 5% mark. So let's take a look at what happens when a bond trades at a premium. So if a bond trades at a premium, that means it's going to be above 100. So a premium above 100 could be any price over 100, 102, 103, etc. So when we say 102 in this case, we see that the price trades up above par, and immediately we know that since there's an inverse relationship between bond prices and yields, the yields would have to shift downward, and so we see that yields actually go down, but they go down in a very specific order. So nominal yield stays the same because the coupon never changes. Nominal yield equals coupon. And then current yield, yield to maturity, yield to call all go down in a very specific order. Yield to call, remember, is always the last one. Nominal yield will be the highest in this case because it never changes. It always pivots around the coupon. And then yield to maturity and yield to call always need to be beside each other. If you can remember that, that'll help you keep track of those two. And then all you have left is the current yield. And so then you have nominal yield, current yield, yield to maturity, yield to call. So let's take a look at what happens when the price is at a discount. So if the price is at a discount, it is below par. So if it falls below par, we know that the inverse relationship means that when bond prices go down, yields go up. So the yields go up over the coupon, and we see that over the coupon means it goes nominal yield, current yield, yield to maturity, yield to call. So again, you'll see yield to call is always the furthest one out. It's always on the outside. So it could be at the highest or lowest level. In this case, it's the highest. Yield to maturity, yield to call, always beside each other. Nominal yield is the coupon, so it never changes. It always pivots around itself. And then current yield is always beside it. So that'll help you remember the order. And these questions tend to show up, and they definitely show up a lot in the practice exams. So definitely know this as best you can, and hopefully that helps. Okay, now let's move on to options. We're going to talk about in the money versus out of the money. These two subjects are also extremely important because they're fairly easy to get once you get them, and they can be a point or two on your exam that could be the difference between a pass or fail. So let's get into this. Now, what does in the money mean? So the simplest thing that you can remember for in the money is going to be something that you'll hear a lot from either instructors or sometimes they may even mention it in the text, but that's the phrase call up, put down. So think of a telephone calling up someone and then putting down the phone to hang up. So call up, put down. That's the easiest way that you'll remember what direction should the price be going in order for a specific option type to be in the money. So for a call option, let's take a look at these examples. Now we have an XYZ December 60 call at 2. XYZ is the corporation, December is the expiration month, $60 is the strike price, call is the option type, and $2 is what we call the premium, or the price of buying the ticket. So in the money is going to be call up anything above 60. So for example, if the market price is 60.01, that is in the money. It's technically in the money if it's anything above 60. Out of the money, of course, would be anything below 60. So $59.99 is out of the money. That is basically all you really need to know. And you'll see the pattern continue here where 61 market price, that's above 60, therefore that is in the money. 59 market price, that is below 60, that is out of the money. So remember, call up, put down. So for calls, we need it to be up or above the strike price. So let's see another example. If it goes to 65, that is also in the money because it's above 60. And if we see here, it goes to 55, the market price is at 55, that is out of the money because it's below the strike price. So for a call, we need it to be above the strike price to be in the money. One other thing that you'll keep, that you should keep track of or take note of is that the premium does not come into consideration here. It's all about the strike price. So if it's 60.01, it's true that this would not be a profitable situation because you paid $2 for the option. You only make a penny because you make the difference between the market price and the strike price for calls. And so you make a penny, but you paid $2. So of course that's not profitable. However, it still is in the money. It would just be like winning a lottery but you won a penny on your lottery ticket and you paid $2 for your lottery ticket. So you wouldn't technically be profitable, but you still would have a winning lottery ticket. Same idea works for options. And at the money is fairly straightforward too. That's just where the market price ends up at exactly the strike price. Okay, now let's take a look at the same logic for options. Now we have an XYZ September 90 put at 150. So we bought this thing for $1.50. $90 is our strike price. And let's see in the money versus out of the money. So again, you can see the pattern working here. Remember, call up, put down. Put down means that we need the market price to be below 90. And we see here 89.99. That is technically in the money. Whereas 90.01 is technically out of the money for a put option because put down, it should be below 90, but it's above, so it's out of the money. And then you'll see the pattern continue just like in the last example. 89 in the money, 85 also in the money, 91 out of the money, 95 also out of the money. It needs to be below 90 for a put option or below the strike price for a put option. At the money is the same as a call option. It's just when the market price ends up at the strike price. Okay, so let's take a quick look now at the rules for bonds when it comes to corporates, munis, and treasuries. Now, the first thing to know is that corporate bonds and muni bonds share a few of the same rules. Treasury bonds have their own rules. So you can kind of separate it out by remembering that corporates and munis are different than treasuries because treasuries are U.S. government bonds. U.S. government, very official, they have their own rules. Corporates and munis, they share rules. So let's start out with the pricing. Now, when it comes to pricing, corporates and munis are priced in 1/8, whereas treasury bonds are priced in 1/32. So what we mean by that is if you have a bond that's priced at, let's say, 101.3, that's going to be 101 3/8 for corporates and munis, and it's going to be 101 3/32 for treasury bonds. So keep that in mind, that the difference between them is that the pricing is in eighths for corporates and munis, in 30 seconds for treasury bonds. Now, another way to keep track of the rules for corporates and munis is that, remember, corporates and munis are two different types of bonds, and so their settlement is T+2. If you can remember that, that'll be helpful because settlement questions tend to pop up every now and then. And settlement for treasury bonds is T+1. So government, very official, they need to settle quicker, T+1, and T+2 for corporates and munis. When it comes to accrued interest calculations for corporates and munis also share the same rules. 30/360, they assume 30 days in a month, 360 days in a year. That's just to make it easy for them to calculate. 30 days, of course, is not in every month, but if you do 30 times 12, that gets you 360 for the year. So it's just an easy way to calculate how much accrued interest is owed. And then accrued interest calculations for the US government, again, needs to be very official. They use the actual number of days in a month, so 28 in February, 31 in March, etc., and 365 days for the whole year. So keep those two in mind. As a little bonus here, we include the option settlement is T+1 and stocks is T+2. So anything corporate related, which would be stocks, corporate bonds, T+2. Muni bonds also falls into that camp. And options and treasury bonds would be the only thing that you would see at T+1. Okay, let's take a look at some forward splits and reverse splits. Now, for stock splits, we want to talk about forward splits first. Forward splits are what you know as a traditional stock split. When you hear the term stock split, what's actually being split is the price of the stock. The price of the stock is coming down and the number of shares are going up. The reason why we have stock splits is because sometimes companies can believe that if their share price gets too high, some investors may not want to invest their money in such a high price stock, so they split it to make it look more appealing, more attractive to invest in. So it's more of a marketing gimmick than anything. We'll see here that it doesn't actually change the value of what you own though. So in this example, Soda Corp announces that they will split their stock 2-for-1. They have 100,000 shares outstanding and the current share price is $100. What will be the price and share count after the split? Okay, so the math here is fairly straightforward. First, you want to take a look at what the ratio is for the stock split. And we say here it's 2-for-1 stock split. So the math is you take 2 divided by 1 and multiply it by shares, and then you take 1 divided by 2 and you multiply it by share price. Now, this is the most straightforward part. As long as you can remember that whatever ratio they give you, you have to divide them by each other and then multiply by the share price and the shares. However, some students get confused as to which they should multiply which ratio or which fraction by. The easiest way to remember that is that if you can remember that for stock splits, you're actually splitting the price, then you know that the price should be the smaller result. So if you take 1/2 and multiply it by share price, and then you take 2/1 and multiply it by shares, 2/1 is just equal to 2, which means you're doubling the shares. So this should be the bigger number. And if you see that the share price is the smaller number, then you'll know that you've done it right. If you find that the share count is the smaller number, you would know that you've done it wrong because the share price would be a larger number. And in that case, you would say, okay, so I did it wrong because the share price is what should be split in a forward split. So if we walk through the math here, we see 2/1 times 100,000 is 200,000 shares. So now you end up with 200,000 shares after having 100,000 shares before the split, and your price ends up at $50. So we have $50 times 200,000 shares, which would be the same as 100,000 shares times 100, which should be 10 million. Okay, so when it comes to a reverse split, now this is going to be the opposite. This might be where our share price is too low and we want to make it look more expensive. So we're trying to get the share price to look higher. Now we have Smoothie Corp announce they will reverse split their stock 1-for-3. They have 100,000 shares outstanding and the current share price is 100. What will be the price and the share count after the split? So we're going to use the same mathematical formula here. So we're going to take the ratio and then we're going to break it out into fractions and then multiply through by the shares as well as the share price. Now the same procedure works here that did for the forward split, namely that you want to check if your logic is correct. So remember, in a reverse split, you're actually trying to shrink the share count because you're trying to increase the price. So you would want to multiply through by your fractions and see if that's true. So if we shrink the share count, we should see a decrease in shares, which we do in this case. It goes from 100,000 shares down to 33,333, and we see the stock price goes from 100 up to $300. So in that case, we would know that we've done this correctly because the share price has gone up and the number of shares has actually gone down. Okay, so that's forward splits and reverse splits. Now let's take a look at easy versus restrictive monetary policy. Easy versus restrictive monetary policy is going to be a discussion typically in the economics section of most of the textbooks, so that's where you'll find a lot of this stuff. Now, we're going to focus on easy monetary policy and restrictive monetary policy when it comes to open market operations, because that tends to confuse a lot of people. So first off, let's start with a few bullet points. We know that when it comes to easy monetary policy, we're talking about interest rates going down, we're talking about the money supply increasing, but we're going to really illustrate how this really goes about happening. Now, when it comes to open market operations, imagine the Federal Reserve as one entity. They end up purchasing from banks some bonds, and the bonds are usually T-bills. So what they do is they inject money into the banks, and then the banks in turn give the Federal Reserve Board some bonds. So they give the Fed some bonds, which takes bonds out of the banks, but injects them with money. So when the money is being injected, that's increasing the money supply because the banks will then be able to turn around and lend that money out to people in the economy. Now on the flip side, restrictive monetary policy is going to do the opposite. We're going to expect interest rates to increase and the money supply to decrease. The reason the money supply is going to decrease in this case is because now the Fed is going to sell commercial banks their bonds. And so when they sell the bonds or the T-bills specifically, the commercial banks are going to pay the Fed some money. So that's going to take money out of the banks and put it into the Federal Reserve. And so as a result, that's money that's going to come out of the economy and not be available for lending. So now there's money that's leaving the economy, and that's going to lower the money supply, which should lower overall economic activity, employment, GDP, etc. So when we have restrictive monetary policy, the FRB will sell T-bills, will go to the bank, which will then give money to the Fed. And then for easy monetary policy, the FRB will buy T-bills, which will take money and be put into the banks, which will then expand the overall money supply. It'll drive up the bond prices because they're buying up bonds, and when you drive up bond prices, that's going to drive down interest rates. So same thing here, where when they're selling bonds, the Fed is selling bonds to the banks, which is going to drive down the prices of the bonds, which is therefore going to increase interest rates. Okay, the last section we're going to look at here is the margin rules. Now the margin rules are important, not so much because they're difficult, but because they often get overlooked, and they're quite an easy section if you get them. Okay, so the important parts of this section that we're going to cover is the one that gets most overlooked, and that's the margin rules when it comes to buying a small amount of stock in your margin accounts. So anything from 0 to 2,000, 2,000 to 4,000, or 4,000 plus. Now, for long and short, they basically have all of the same rules, except for between 0 and 2,000, long must put up 100%. Now, when it comes to short, they have to put up 2,000. So for example, if you have an investment of, let's say, $200, if you're long Apple stock, $200, you have to put up $200 or 100%. But if you go short Apple stock by $200, you have to put up $2,000. And that's because a short position is much riskier. So since it's riskier, you have to put up more. Okay, and between $2,000 and $4,000, you'd have to put up $2,000 for long and $2,000 for short. So for example, if you invest $2,500 in stock ABC, you'd have to put up $2,000 if you're buying that stock. If you shorted $2,500 worth of ABC, you'd also have to put up $2,000. Now when it comes to investments over $4,000,
Then it's just the straight up 50%. This is the Reg T rule that you're probably used to seeing, the Reg T 50% rule. Now, that would be if you invest $5,000 into ABC Corporation, you have to put up $2,500. If you short $5,000 worth of ABC stock, you also have to put up $2,500. So let's take a look at a couple examples. Catherine goes long 40 shares of GHI at $10. How much must she put up for her initial margin requirement? Well, we see here that $10 times 40 shares is $400, and she's going long, so she's buying. If she's going to be buying, that means she's got to be putting up 100% because $400 falls between 0 and 2,000, so she has to put up the full $400. Next, Johnny shorts 40 shares of GHI at $10. How much is his initial margin requirement? So in this case, same basic question. Johnny now is shorting $400 worth, but remember, he's short, not long. So with the short being a much riskier position, he has to put up more when it comes to the investment falling within $0 to $2,000. So he's actually going to have to deposit $2,000 in this case. Okay, so that's a wrap on our SIE cheat sheet. If you have any questions, please feel free to reach out. And again, if you want the full video courses, please check out our website, www.professionalexamtutoring.com, or you can email me personally and we can set up tutoring with myself or any one of our great tutors.